Hello, and welcome to Markets in Focus. My name is Joe Bell, and today I'm going to walk you through some of the most interesting financial market themes that I'm observing. All right, strong start to 2023 with equities surging. We've had a bit of a pullback over the past several weeks, but so far, developed international, especially Western Europe, has been leading the way across the globe. Interest rates, right? That was the big story of 2022. Well, that story has not gone away. Interest rates continue to move higher, and expectations for the Fed funds rate continue to move higher as well. And finally, those interest rates can put pressure on equities. And one of the reasons why, one example why recently we've seen massive flows into cash-like ETFs as equity risk remains very high. So international equities lead the way in 2023. We have on this chart, on the far left, you have Italy, all the way to the right, China, and you have in the blue bars, year-to-date return in the local currency. The orange diamonds are the year-to-date return, and the light blue is basically the contribution to FX. That's the currency translation from the local currency to US dollars, whether that detracted, in this case, pretty much across the board detracted from international returns year to date. The real theme of this chart, if you look at it, you can see Europe, especially Western Europe, has outperformed US dramatically. Emerging markets dragged down significantly by China, right? The struggles they've had with the reopening here. Emerging markets severely lagging. We're seeing emerging markets bonds, the same thing, underperforming US high yield bonds to start the year. So far, the stocks Europe 600 index, right? Their big cap equity index is outperforming the S&P 500 by 13% over the past year. For those of you that don't recall, international has lagged the US for more than a decade. So we're starting to see some shift. Now, we've seen some of these fits and starts before from international. It's a little too early to tell whether this is a major shift that starts to lead to a multi-year outperformance for international. But no doubt that we have seen some signs over the past few months of a little bit of a change in leadership. Interest rates expectation. So on the chart here, we have in the light green, the yield curve from starting at 1 month US Treasury all the way out to the 30-year. And right, you can see that short maturities are much higher than longer dated maturities. And that's that yield spread that you're hearing so much about, or you have been hearing since early June of last year, the first time when this inversion happened, right? What's this mean? Well, it means the short end of the curve interest rates are higher than long end. That's not normal. Typically, you would expect longer dated loans to charge higher interest rates. What this means is the market is expecting slower economic growth over the long term that's going to bring interest rates down, right? Expecting some sort of a recession, some sort of an economic slowdown that's going to bring the current interest rates lower, right? But this has been moving higher. You can look at the yellow as the start of February, green is the end of February. During that month, we've seen rates shift higher. Right now, if you look at the 6-month Treasury, the 2-year Treasury, they're at fresh cycle highs north of 5%. Why is this important for equities? Well, a couple of reasons. If you look at the Fed funds rate, the expectation for the terminal rate, right, the peak for the Fed funds rate, it's been moving higher and higher. It's getting pushed out further and further. And you can see right now, based on the probabilities from the CME watch tool, looking at futures transactions from market participants, the probabilities based on transaction look like this: 70% chance that at the next March meeting, we're going to see the Fed funds rate move up 25 basis points to an upper bound of 5% for the Fed funds rate. You can see at May, expected another hike of 25 basis points. At June, an additional hike of 25 basis points. This has continually been pushing higher as the Fed has come out. Some of the jobs reports have been strong. Signs that maybe inflation is not subsiding as quickly in some areas, especially in that labor market, which has remained strong. You're seeing right now that the Fed is expected to raise at least 3 more times through the end of the year. There's still quite a bit of debate about whether they're going to pause or cut. Probabilities on the out toward the end of the year still say, hey, they might actually cut. I think that's maybe, in my opinion, the pause is probably a little more likely as we end the year. Now, what's this mean for equities? Well, we've talked about it before. Stocks now have competition from bonds, right? Over the past several years with interest rates at zero, investors did not have a lot of places to go. When you have a US Treasury 6-month yielding 5.1%. Dividend yields of stocks within the S&P 500, most of them are below 1.7%, right? All of a sudden, income in fixed income looks a little more attractive. You don't have to look far. Over the past week or so, we saw a massive increase in cash-like ETFs. In fact, if you look at the 5-day sum, which is the bottom part of this chart, that reached $8.6 billion. That's the highest that we've seen over the past several years during the midst of the market declining just a little bit. I think this is a good reminder of what equities may face throughout the year. Even though perhaps October was the bottom, we don't know for sure, but we've seen some signs of strong market breadth that's encouraging off those October lows. Even with that, I think interest rates where they're at continue to create a headache for stocks, right? Investors, if they worry at all, now have places to go to earn interest in ways that they just haven't had in several years before. All right, before we wrap it up, iPhone 2007, okay? Everybody's always trying to get the latest and greatest, right, technology every year, every 2 years. Well, one woman kept the iPhone 2007. The story why, the background story was, I guess she had got another new phone, didn't think about it, kept it in a box. Years had passed. She's like, oh, maybe this will be worth something. Well, in the start of 2023, she went out there and saw, yeah, this might be getting a bid of around $5,000, $6,000, unopened, perfect condition, 2007 phone. Unbelievably, not a lot of people kept them in the box like this, so it's pretty rare. Well, the estimates were wrong. It went for a sale of more than $60,000 in an auction on February. Some people saying the opportunity to own a piece of history in its original condition. So many people open them because of the technology. There are very little that are actually untouched in their original box. $60,000. So for those of you that want to make a little return on your investment, maybe buy a couple phones, keep one in a box. If this trend doesn't pick up too much, maybe you can earn some money here in the next 15 years and turn that investment into a profit. With that, I want to thank everyone for watching, and I'll see you next time.